Welcome, everyone. Thanks for taking the time to join us for this session. Today, we're stepping back and looking at how 2025 really reshaped the rules of the road for crypto-enabled payments. Over just the past year, we've seen Congress sharpen its focus on digital assets, and regulators have issued increasingly detailed guidance as the market continues to evolve. So our goal in this discussion is to kind of make sense of all of that and everything that's happened in 2025 and how that will translate into practice as we move into 2026. So briefly about us and the perspective that we bring to this discussion. I'm Chris Boone. I'm a partner in Venable's Financial Services Group. My practice focuses on payments and crypto compliance with an emphasis on how program structures and payment flows and regulations interact in a real world kind of deployment scenario. So I primarily work with banks, processors, card network, fintechs, and crypto companies, helping them to navigate the regulatory environment and manage compliance risk. And I'm joined by one of my partners, Megan.
Hi, good afternoon. I'm Megan Barbero. I'm delighted to join all of you this afternoon to talk about the crypto landscape. As Chris said, a lot has changed in 2025. We will look back on that and look forward to 2026. I joined Venable in 2025, coming most recently from the Securities and Exchange Commission, where I had served as the general counsel. I have previously served in senior roles at the House of Representatives and the Department of Justice, and I'm a partner in the Financial Services Group and our Administrative and Regulatory Litigation Group, and very excited to talk with all of you this afternoon about all of those administrative and legislative changes that Chris mentioned. So with that, back over to you, Chris, and we can get started.
Thank you. So let's take a kind of quick look at the agenda for today and the topics we'll be covering. First, we're going to quickly walk through some digital asset and stablecoin basics, and then we'll pivot to the current regulatory landscape and the main developments of 2025 with a focus on what matters most from a regulatory and compliance perspective. And then we'll turn to Congress and legislation. There's been a flurry of activity and proposals that attempt to bring more structure to this space. And with the Genius Act, which has been signed into law now governing payment stablecoins, there's quite a bit to discuss. We'll also review key rulemakings and guidance that will be coming out in the future as we kind of turn towards a future-looking discussion and the kind of regulatory posture we expect to see next year. And then we'll kind of wrap up with an FAQ where we go over some of the frequent questions that we've encountered over the past year and provide some kind of closing thoughts to tie everything together. And so with that, I will hand it off to Megan for the kind of crypto and stablecoin basics.
Thanks, Chris. And these next few slides are familiar territory, I'm sure, for many of you listening, but we wanted to be sure to cover the basics and where we are in terms of digital assets. So I'll move relatively quickly through the next few slides, but we will, of course, have time for questions at the end if you have any. So this first slide here is just a little bit of background on crypto, which is a digital or virtual asset that uses cryptography for security. And unlike traditional currencies that are issued by governments, cryptocurrencies are decentralized. They operate on blockchain technology, which is a distributed ledger maintained by a network of computers. And every transaction is recorded on that public ledger. It can't be changed. There are a few key features, which again are familiar territory for many of us now. Crypto assets are decentralized, so there's no single authority like a bank or a government that's controlling the system. They're transparent in the sense that transactions are visible on the blockchain, and they're anonymous. So the transactions are through wallet addresses and not personal identities or identifiers. And some of the major cryptocurrencies are Bitcoin, Ethereum. There's, I think the chart here shows the increase or use of cryptocurrencies. The use cases include digital payments and remittances, investment and trading, DeFi, so decentralized financing, lending, borrowing, earning interest without intermediaries. And you can see in the chart that we have the reasons that U.S. adults are using cryptocurrencies in their transactions. The number one reason is that the recipient prefers the transaction be conducted using a cryptocurrency. Also, sending money faster or cheaper, maintaining privacy are all key reasons there. And I think, Chris, we can go ahead to the next slide now and just see a few more specifics on stablecoins. And we'll get to this later in the presentation, but stablecoins are a subset of cryptocurrency. They've become a major part of the digital asset ecosystem, as you can see in this graph here that shows the increase in stablecoin payments over just the last couple of years. So the total stablecoin supply is now approaching $300 billion, marking one of the strongest periods of growth since stablecoins were first issued. And the overwhelming majority of stablecoin supply remains pegged to the US dollar. And recent market cap data suggests that the US dollar denominated coins account for about 99% of stablecoins globally. Just to give you a sense of how overwhelming the US dollar is as the reference dollar. And we're continuing to see an acceleration. So over the past year, the number of stablecoin wallets has grown by more than 50%. Monthly on-chain volume has doubled, and stablecoins are no longer used primarily for crypto trading. They're now supporting payments, remittances, other financial transactions. And settlement activity is done on multiple networks. Tron and Ethereum are consistently among the most utilized for high volume stablecoin transfers. But taken together, this slide and all of these trends show, this is a maturing and rapidly scaling market, and stablecoins are becoming increasingly widely adopted across blockchain-based financial instruments. And so I think with that, we can go on to the next slide here. Again, this is some additional background information, a little more detail here. Starting with minting and redemption, this process works much like purchasing and redeeming a prepaid digital asset. So for example, if someone wires $1,000 to a stablecoin issuer, they send it to Circle, they would receive 1,000 USDC in their wallet. Then if that person later needs dollars, for example, they've got payroll or expenses or settlement, they can return the tokens to the issuer and the issuer will send back cash. So this mint redeem cycle is what is keeping the token tied closely to the dollar. Then in terms of reserves, in order to maintain stability, issuers hold high quality liquid assets. It's mostly cash and short-term treasuries. The idea is that these reserves will function like the backing of a money market fund, ensuring that the issuer can meet redemption. And the goal is to be able to do that even in times of market stress. In terms of programmability, interoperability. The stablecoins live on programmable blockchains, and they work with smart contracts that allows, for example, automatic release of funds when terms are met in an escrow arrangement. For example, scheduled payments can be done without going through a bank. Interoperability also means that a token minted on one chain can be used across many wallets, exchanges, decentralized applications. The idea is to have a less friction in the system. And primary use cases, as we mentioned here, it includes faster cross-border payments and remittances, merchant settlement, serving as core collateral. And institutions are using stablecoins for around-the-clock treasury movements. So the blockchain is always open 24/7. And in some, especially high inflation regions, they can provide a practical digital dollar option. And with that, I think I am turning it back over to Chris to kick us off on the regulatory landscape.
Thanks, Megan. So now we will turn to the regulatory landscape, which has really kind of fundamentally shifted in the past year. So at the top, and as we shift to the policy environment, it's important to frame how the current administration is positioning itself around digital assets. The clear message from the White House has been a desire to lighten the regulatory load on the crypto industry and kind of present the United States as a global leader in the digital asset space. And this isn't just talk, though. This has been backed up with some significant action, kind of setting the stage for the current policy direction. So, first up, we have the Digital Assets Executive Order. There's also been very key agency appointments, which has created a kind of a clear break from some of the prior enforcement posture of the previous administration. And the new leadership at the SEC, the CFTC, and at Treasury in particular have kind of paved the way towards a more flexible and open approach to the crypto industry. And we'll kind of break some of these down in the next slides. So with the Digital Assets Executive Order, which was issued in January, right at the start of President Trump's term, one of the first things that order did was revoke a number of previous executive orders and guidances that had an effect from the industry perspective of harming or otherwise kind of cabining the ability for some crypto firms to be able to operate. So it rescinded, for example, the executive order issued under President Biden, which highlighted concerns surrounding digital assets and called for comprehensive regulatory reform and comprehensive digital asset policy. The Secretary of Treasury has also been directed to revoke the International Framework on Engagement of Digital Assets, which was intended to address and mitigate some of the systemic risks of digital assets, protect consumers and investors, and mitigate illicit finance and national security risks. And then kind of in place of that, the order established the President's Working Group on Digital Asset Markets. So this interagency group has been tasked with developing a different sort of federal regulatory framework for cryptocurrencies, including stablecoins, and evaluating the kind of potential creation of a national digital asset stockpile, which has become its own animal, and how that's kind of been discussed on the Hill, which we won't get into too much. And one of the kind of important things to kind of highlight and note is there have been previous discussions and talk about the potential study or creation of a central bank digital currency. Under the current administration, that's basically been a non-starter. Trump has been very clear that he has been opposed to a CBDC. One of the most kind of like interesting things that kind of developed over the past year is this DOJ memo. So in early April, the Deputy Attorney General issued a directive to the entire department that reoriented how federal prosecutors approach crypto-related cases. The core message was pretty straightforward. The DOJ is taking a step back from enforcing violations kind of premised on unclear or evolving regulatory obligations rather than clear statutory violations. So pure regulatory offenses such as registration failures are not a priority. So exchanges, custodians, wallet providers, and even mixers are not supposed to be charged simply because a user engaged in misconduct or because the company made an inadvertent compliance mistake or failed to register under the correct registration category. Instead, the DOJ is narrowing its attention to core criminal conduct, naming terrorism financing, narcotics trafficking, and cartel activity as its focus. The memo also dissolved the DOJ's National Cryptocurrency Enforcement Team, which had served as the kind of central hub for many of the DOJ's aggressive crypto enforcement actions in the prior administration. So taken together, the DOJ memo represents a major recalibration away from the regulation by enforcement posture that the crypto industry had as a kind of a critique against the prior administration. Alongside the DOJ's kind of evolving stance, the SEC has also been very active in reshaping its approach to crypto. First, the SEC formed a new crypto task force to develop clearer policies and work with industry stakeholders on compliance and regulatory goals. The SEC also formally withdrew prior guidance and pending rules that would have placed restrictions on some forms of crypto activity. So, for example, in May, the SEC formally withdrew Staff Accounting Bulletin number 121, ending the requirement that public companies holding crypto assets for clients record those assets as liabilities on their balance sheets, a move aimed at reducing the barriers for banks and custodians entering the crypto space. The SEC also withdrew proposed Rule 3B16 in June, which aimed at expanding the definition of an exchange to include certain decentralized finance or DeFi protocols. This amendment would have tightened cryptocurrency standards for investment advisors, but now that rule has been withdrawn. That proposed rule has been withdrawn. And then I'll pass it to Megan to talk a little bit more about the new guidance that the SEC has put out on select issues.
Great, thanks, Chris. And the next couple of slides here will touch on staff guidance around crypto and what is and isn't a security. And taken together, the staff statements are aiming to provide some clarity that activities that, for example, simply help a blockchain to operate, like staking and mining, and stablecoins that are structured as true dollar substitutes, do not involve the offer and sale of securities. There are guardrails that are detailed in the staff statements, but before we get into the details, it's also important to note that these are staff statements. They're not statements of the SEC acting as a commission. They're from the SEC's Division of Corporation Finance. They're not formal SEC rule changes. They're not legislation. They do represent the staff's current interpretive view, but because they're staff statements, they could evolve in the future. It does not require a commission vote to change the statements. It's essentially an indication that the Corp Fin staff would not recommend an enforcement action to the enforcement division. It means it's less likely the enforcement division would take any action based on what's in these statements. But again, these are malleable, and we could see additional changes down the road. So we will be keeping an eye on that. But with all of those caveats, let's go ahead and jump in on the substance of the staff statements. So the first that we mentioned here, and these are not in chronological order, but maybe in logical order. The first is on proof of stake networks. And so proof of stake is a system where people secure a blockchain by locking up or staking their tokens, and that helps validate transactions, and the protocol may reward them for doing that work. In a May 2025 staff statement, CorpFin stated that certain protocol staking activities on public, permissionless proof of stake networks do not involve the offer and sale of securities. So that's carving out from the securities laws protections certain staking activities. And the staff explained that staking that is, and this is a quote from the staff statement, intrinsically linked to the programmatic functioning of a public permissionless network is not the offer of a security. So that conclusion applies whether someone stakes directly or whether someone is using a provider that is helping with the technical side. The important limitation in the staff statement is that it's confined to protocol level staking where rewards are determined by and paid through the network itself and do not reflect additional economic rights or yield engineered by a third party. In other words, there are circumstances in which the SEC could find, looking at all of the facts and circumstances, that there was a securities transaction at issue. So again, it's important. The details are important here. But going on to the proof of work mining, this is the second of these staff statements on our list here. Proof of work this is the older model made famous by Bitcoin. So here miners are using computer programs to solve cryptographic problems and validate transactions. And in March 2025, staff and CorpFin issued a parallel statement saying that this activity does not involve a securities transaction standing alone by itself. Again, mining on public permissionless proof of work protocols is not the offer or sale of a security. And this applies both to individual mining and mining pools. And as with staking, the staff drew a line between participating in the network's core infrastructure, which is not the offer and sale of securities. It's not securities transaction covered by the securities laws. They drew a line between that and participating, for example, in programs that are marketed as financial investments. And then the last staff statement that we have on the list here is from April, and there was a lot of press coverage of this one when it came out. It's the stablecoin statement. And here the staff were focused on dollar-backed stablecoins used for payments and determined that covered stablecoins do not involve the offer and sale of a security when the coins are redeemable one-to-one for US dollars. And to qualify, the stablecoin must be backed entirely by, this is staff's word, low risk and readily liquid assets, such as cash and short-term treasuries. And the reserves cannot be lent, pledged, or rehypothecated. So the idea is that a fully reserved payment stablecoin that is designed to function like a digital dollar does not resemble an investment contract. That's not going to be considered by the staff to be a security. And I think that we have a few more staff statements to cover on the next slide here. So the first one, again, this received a lot of press coverage at the time it was issued in February, is the meme coins staff statement. This also, there was a dissent from Commissioner Crenshaw on this one as well, so it did get a lot of press. But staff in this statement addressed the growing number of meme coin-based tokens and emphasized that in the types of meme coins that are described in the statement, those meme coins are generally behaving more like collectibles than securities. And so their value is often driven, by the hype around the coin, by online culture, not by the underlying business. And so the staff in the memo said the value of meme coins is derived from speculative trading and the collective sentiment of the markets like a collectible. And that's like a collectible, not like a security. And it's important to note that labeling something a meme coin alone does not exempt a token from federal securities laws. It is going to depend on the circumstances, how the project is marketed and structured, and whether it meets the test for an investment contract. But the staff statement is at least an initial shield of sorts for meme coins, and again suggests that staff will not be recommending enforcement actions for those coins that meet the standard in the statement. And then we have the broker-dealer FAQs. These also clarified how existing broker-dealer custody requirements should apply to crypto assets. And the core point here is that, and this is not, this is pretty standard fare, that the broker-dealer rules, the strict possession and control rules apply only to securities. So if a broker-dealer is holding crypto assets that are not securities, and we just talked about what, the conditions under which some of those would not be securities, such as collectibles or certain payment tokens, they can do that without triggering those custody rules. And the staff's goal here is, to provide some additional operational clarity for firms that want to offer access to non-security digital assets while staying within the existing regulatory framework. And then the last piece that we have on the staff statements is disclosure guidance for crypto securities offerings. And in this guidance, which came out in April, the staff reiterated that when a crypto asset is a security, the usual securities disclosure regime will apply. So there's not a separate regime for digital assets that are securities, but issuers offering crypto securities, they have to do the same things you would do for any other securities offering in terms of clearly describing the business model, material risks, the nature of the crypto securities being sold, just as you would for a traditional securities offering, and have the same level of transparency. Investors should have the same level of information. So this disclosure guidance really works hand in glove with some of the other guidance in terms of the other guidance is providing some guardrails around what is and isn't a security, but if you are offering securities, even if they're digital assets, you do have to comply with the existing securities disclosure requirements. And I think with that, I will turn it back over to Chris.
Thank you. So also on the banking side, there has been a significant shift in how they are approaching cryptocurrency activities. So the OCC, FDIC, and the Federal Reserve have all moved to eliminate some prior approval requirements, signaling a broader effort to normalize crypto within the kind of traditional banking system. These changes are really aimed at reducing barriers for banks while still emphasizing the need for strong risk management. So, for example, we have OCC Interpretive Letter 1183 that was issued in March. And in that letter, the OCC rescinded a 2021 supervisory non-objection process, where previously banks needed to get written approval showing they had the necessary risk controls before engaging in certain crypto activities. And this letter eliminates that prior approval requirement, giving the banks greater autonomy, but still with the expectation that they manage risks effectively. Similarly, Interpretive Letter 1184 builds on the 1183 letter, clarifying that banks can engage in buying and selling crypto assets held in custody and can rely on third-party vendors for certain execution services, so long as they, again, meet third-party risk management controls and are effective in those controls. So there are still expectations that need to be met, but the prior approval type processes have been kind of stripped away. We're also seeing that with the FDIC and the Federal Reserve. So Federal Financial Institution Letter 7/2025 rescinded a Biden era requirement that state chartered banks submit for prior notice and get the FDIC's non-objection before starting crypto activities. And on the Federal Reserve side, the Fed removed supervisory letters that had mandated advance notice for crypto activities by state member banks. So taken together, we are seeing a kind of a step back from the approval or prior notice regime to a more open regime, but that where risk management and third-party risk management procedures, safety and soundness type concerns are still applicable, but crypto isn't being treated as a completely unique, novel item that requires a special process. It is subject to the kind of existing and standard supervision and exam process. So we've talked about the SEC, we've talked about the banks, we've talked about the Department of Justice and the Trump administration kind of more generally. Now we're going to turn to Congress and some legislative updates. So first up is the Genius Act. There have been a number of bills over the years directed at the crypto space, but the Genius Act is the first significant act that has been passed into law. So it was signed into law in July, and it lays out for the first time a national regulatory structure tailored to stablecoins. At a high level, the statute creates a coordinated federal oversight regime. It doesn't fill in every detail, as much of these details will be kind of fleshed out through rulemaking in the coming years. But it does tell us who the primary regulators will be and the main guardrails that stablecoin issuers and digital asset service providers will need to know to be able to operate in this space. Significantly, any stablecoin issued under this framework, under Genius, is expressly excluded from being treated as a security or as a commodity. That, in and of itself, removes a major source of regulatory tension. And in the next slide, we'll kind of go over some of the other main provisions and key takeaways. So the Genius Act does cover a lot of ground, but here are the kind of primary provisions that we would like to highlight. So for licensing, both banks via subsidiary and non-banks are allowed to become issuers, but all issuers must apply and obtain approval to issue a stablecoin. And it's important to kind of highlight the choice to allow non-bank issuers was not a given. Previous proposals tried to limit issuance to insured banks. But in the ultimate draft that was passed, both banks and non-banks can be permitted payment stablecoin issuers. Another really cool feature is this application decision shot clock. So there's a 120-day shot clock that will effectively force regulators to act, either approve or deny an application. And if they don't approve or deny an application in that time period, it is deemed approved. So this is really aimed at preventing a kind of regulatory limbo where the regulator fails to act on an application, effectively kind of preventing any kind of movement without reaching any formal decision that could be appealed. One of the strongest features of the Genius Act is its treatment of reserves. I know we kind of talked about reserves when we were discussing stablecoins kind of more generally, but here it's really, put into practice, into the law. Every issued stablecoin under Genius must be fully backed by reserves in very safe assets. These are, treasuries, cash, or equivalents. Anything that would resemble risk taking, like other crypto or corporate debt equities, would be off limits. And the act also includes robust redemption requirements. So stablecoin holders, the customers or consumers holding the stablecoin, must be able to convert back to dollars quickly. And this aims to prevent runs and kind of reinforces the equivalency to fiat. So when you have the one-to-one reserve requirement and the strict redemption rules taken together, it's really reflecting the bill's emphasis on payment functionality over any kind of investment use case. And also, we talked about interest and yield a little bit. Genius gets into this just a little bit by prohibiting issuers from paying any form of interest or yield to stablecoin holders simply for using the stablecoin. In practice, this bars issuer run or protocol level staking programs for stablecoins. And then as a kind of a final note, the regulatory structure is somewhat split between federal and state. So federal regulators will get automatic control over big issuers, those with over 10 billion in issued stablecoins. But smaller issuers can operate under state law if the state's rules have been certified. So once an issuer crosses that 10 billion threshold, it will automatically get to that federal oversight. So this is kind of a dual regime that allows states that want to lead in this area some space to operate. I would like to, now that we're about halfway through, I would like to mention the CLE code. The CLE code for today is Clarity 2025. That is one word, and capitalization does not matter. That's again, Clarity 2025. One word altogether, and capitalization does not matter. So I've encountered a lot of questions about how the Genius Act applies to digital asset service providers or DAPs. A digital asset service provider is a new defined term used in Genius, but the Act does not make DApps a primary focus. The term is quite broad. It covers businesses that exchange or transfer digital assets or custodians, anyone that kind of touches the flow of funds or provides other financial services related to issuing a digital asset. The main regulatory compliance obligation for DApps under Genius is pretty simple. The Act prohibits DApps from offering, trading, selling stablecoins that have not been issued by a permitted stablecoin issuer. It essentially adds an extra enforcement layer to ensure that only permitted stablecoins are being offered in the US. This prohibition is not automatic. It goes into effect 3 years from the date of enactment. So this allows some time for the regulatory structure and the licensing structure to kind of come into place before this really kind of ramps up. Unlike with the permitted stablecoin issuer concept, though, there's no independent registration, approval, or licensing requirement for DApp. They're kind of their own category and they don't have a specific licensing regime. There is a special rule for custodians of payment stablecoin reserves. Just to kind of briefly mention, payment stablecoins must maintain a separate accounting for the stablecoins and for the reserves, and they cannot be commingled with other assets. And that's for those acting as the custodians for stablecoin reserves or when payment stablecoins are used as collateral. And now we'll have Megan talk a little bit about the Clarity Act.
Great, thanks, Chris. And before I get to the Clarity Act, I know we've gotten a number of questions in the chat. We had a lot of ground to cover. I know time is going to be short. And because we may not circle back to the meme coins point at the end, I did want to answer a question that came in about meme coins, which is if meme coin prices are influenced by speculative trading, then how could they not be considered a security? And I'd refer all of you to Commissioner Crenshaw's dissent from the meme coin statement, which addresses exactly this issue, among other questions. But the Howey test, which is what the staff was looking to determine whether the meme coins were investment contracts and qualified as securities, requires not only an investment of money in a common enterprise, but with an expectation of profit derived solely from the efforts of others. I think the argument in the staff statement is that the meme coin purchasers are not expecting profits from the efforts of others because the coin's value is going to be derived from speculative trading and, the sentiment of the market. Commissioner Crenshaw had some responses to that point in the staff statement. I don't want to go through all of them here, but just to answer the question, I think it's worth looking at that dissent, and also that is the reasoning of the staff statement there. But that was a contested issue. So now switching back over to the Clarity Act here, and we can again move through some of this material on this slide and the next slide relatively quickly, including because I think the Clarity Act, while passed by the House, faces a potentially uncertain future in the Senate. But to talk a little bit about the background here, it is one of the first major attempts by Congress to provide a clear statutory framework for digital assets and address some of the questions that have been unaddressed and presenting challenges for the last many years, including the distinction between digital commodities and securities, which is a line that courts and agencies have struggled with. And the bill tries to separate the transaction that raises capital from the token that later trades, so that you could have a fundraising sale treated like a security without forever classifying the asset itself as a security. And the division of responsibility here is between the SEC on the one hand, which would have regulatory and enforcement authority over securities, and the CFTC on the other hand, which would have the same authority over digital commodities. And it's an attempt to try to reduce some of the overlapping jurisdiction there. I think we talk a little bit about the exempt pathways on the slide. So that's an exempt pathway for token offerings, which is designed to give early stage projects a compliant way to raise money without having to go through the full cost of SEC registration, still having some disclosures. And then the maturity concept here reflects an effort to recognize that some networks will evolve over time. And then once a project reaches a certain operational stage, its tokens may be regulated more like commodities than investment contracts, which are securities. So overall, the bill is an attempt to move from more of a case-by-case determination to something that industry and investors and regulators can all rely on to provide some rules of the road from the jurisdictional perspective. And so here we have a continuation of the overview. And again, a major change in the bill, it would be assigning the CFTC primary authority over the spot markets for digital commodities. So that's the trading of crypto tokens that are not securities. And it's an attempt to kind of, again, provide some clarity, fill a regulatory gap by creating registration categories for exchanges, brokers, dealers, while still providing some core AML protections, customer safeguards, segregation of assets. And there is a provisional registration in the bill, which is aiming to avoid disrupting existing platforms, so allowing firms to continue to operate as they are now while the CFTC finalizes detailed rules that would be called for under the legislation for this new regime. And there's also, we have here the crossover rules, which would give SEC registered ATSs and broker dealers some limited ability to handle digital commodity activity without taking on a full dual registration with both agencies. And I think we have right there, the thresholds there provide kind of a measured way for traditional firms to participate in that market. And the bill would also, bring some attempt to bring some clarity on DeFi and infrastructure providers. So the developers and validators, other non-custodial actors are explicitly not treated as financial intermediaries or money transmitters. And here the purpose is to ensure that those entities that are building software, running the network infrastructure, not holding customer funds, are not regulated in the same way that platforms that are holding and custodying assets would be regulated. So again, as I mentioned at the outset, I think there's a little bit of uncertainty now about what happens in the Senate. The bill passed the House with bipartisan support, but there are differing committees of jurisdiction. There's a question about whether the legislation might be split up into different bills. And so again, we're continuing to keep an eye on that.
Yeah, that's absolutely right. So the Clarity Act is kind of stalled in the Senate as the Senate kind of considers its own approach. So first is the Responsible Financial Innovation Act, and this has been split into two different committees. The first discussion draft was released by the Banking Committee. That was released in September, an updated version of the discussion draft. And that approach, while also heavily focusing on market structure, it takes a little bit of a different approach and a few kind of tweaks and changes. For example, this half of the discussion draft gives the SEC statutory direction for how to treat digital assets. And one of the biggest elements is the creation of an ancillary asset category. So the goal is to distinguish a digital token from the underlying investment contract that it may be associated with. The draft bill also requires the SEC to formally define an investment contract to bring additional clarity to the boundary between security and non-security in this space. Also under the draft bill, qualifying ancillary assets would not be treated as securities. Initial distributions would still require limited disclosure process, but once those assets move into the secondary market, they would fall outside of the securities laws. There are additional guardrails, again, for like developers that make clear that publishing software alone does not make someone a money transmitter and things like that. So there are a lot of commonalities between the Senate market structure draft bill and the Clarity Act, but also some kind of differences in how they approach the kind of overall regulatory framework. Alongside the Banking Committee, the Agriculture Committee recently released their own discussion draft of the RFIA. The Agriculture and Banking Committee draft each kind of address matters within their jurisdiction. So the banking draft is primarily governing the SEC and federal banking regulators, while the agriculture draft is primarily governing the CFTC's role. And the drafts are designed to complement each other. And then together they would aim to create a comprehensive federal market structure framework for digital assets. So this discussion draft would require digital commodity exchanges and custodians to register with the CFTC and comply with various trading rules, risk management, and other kind of regulations concerning consumer disclosures, segregation of customer assets, record keeping, reporting, and things like that. As of now, the RFIA remains a discussion draft. It has not been formally introduced as a bill, but there have been public statements that Republicans in Congress intend to hold a committee markup in December, I believe, to kind of move a crypto market structure bill in the Senate to the Senate floor in early 2026. And this would be in coordination with both the Agriculture and Banking Committee's drafts. So we'll see how that kind of plays out in the coming months. And now we are kind of looking forward, and I'll hand it off to Megan.
Great. Well, and thank you everyone for sticking with us here for the looking forward piece. And we'll touch on the Treasury advance notice of proposed rulemaking, and then sort of quickly touch on what regulators are looking to in implementing the Genius Act, and want to try to leave a few questions at the end, or a few minutes at the end here for questions. So I spent a lot of time working on rulemaking. The Treasury and PRM is the very beginning of a rulemaking process. As many of you know, it could take quite a bit of time before we see rules implementing the Genius Act, and the scope of Treasury's request is understandably quite broad. Treasury posed 58 questions across 6 major topic areas, and the signal is that they're building out a regulatory framework. They've got a lot of ground to cover in the regulations. There may be some adapting existing financial rules, but I think also some of it will be coming up with new rules of the road that work in implementing the act. And the questions really highlight what the agency is trying to manage, creating guardrails without shutting down innovation. One example is, how do you design requirements to protect consumers while still allowing new payment technologies to develop and continue to develop? And so with that, I think we can, we'll be monitoring closely. We haven't seen anything out of Treasury yet in terms of a proposed rule, but that will be forthcoming as they're taking in all of the feedback that they got from the ANPRM. And so we can turn now to the next slide, which is about the key issues that regulators will be looking at as they implement the Genius Act. Obviously, fraud prevention will remain one of the top priorities. Many enforcement actions that we've seen recently stem from situations where you've got bad actors who are, simply plugging crypto into an existing scam model. That's obviously putting pressure on regulators and also on legitimate firms who are developing fraud detection and consumer protection practices. But that will continue to be a focus. A second area, and we touched on this a little bit earlier, is capital liquidity and risk management, especially in the stablecoin space. And there's the concern is about stretch market conditions and whether individual issuers can meet redemption requirements, and also, a systemic concern with instability in this sector and whether it could spill over into traditional financial markets. So regulators are taking a systemic look at this. And of course, illicit finance continues to be a focus. The crypto, as we talked about at the beginning, both digital assets and stable coins offer lots of advantages for legitimate users, but they also have features, including speed, borderless transactions, programmable transactions, anonymity, which can be exploited by money launderers or people trying to avoid sanctions. And so the goal, again, is not to stymie innovation, but to ensure protections. And across, all of these topics, I think regulators are generally concerned about how firms are designing and operating their systems, and that will continue to be a focus. So now we are going to the frequently asked questions piece, which may also touch on some of the questions we've gotten in the chat, and I can turn it back over to Chris. I think these are focused really on the Genius Act. So Chris, back over to you.
Sure. So we've encountered these questions a lot, and the very first one, like when does the Genius Act requirements go into effect, is actually kind of nuanced because there are different triggers. The kind of baseline trigger for like the issuer rules is 18 months from enactment, but it can be potentially shorter because it also is triggered 120 days after the primary federal payment stablecoin regulator issues final implementing regulations. So we're really looking at 2027 as being when enforcement risk ramps up. Implementation could be earlier if rules are finalized before then. That kind of seems unlikely that they would be finished significantly before that 18-month kind of baseline. But we don't have a crystal ball, so we can't say for sure. And then there's also that 3-year transition period for offering of non-compliant stablecoins for DAF. That's a kind of a separate trigger and separate requirement with its own kind of period for enforcement. Another kind of question we get a lot is,
Chris, I'm going to if I could just interject, because we are at 3:00 and I know that folks are having to drop off, and I just want to make sure for anyone who's leaving that you have the CLE code. So Chris gave this to you about halfway through, but again, that code is Clarity 2025, all one word. And thank you for joining us and staying with us. And again, it's Clarity 2025 for CLE credit. Thanks, and sorry for the interruption, Chris.
Yeah, no worries. And we won't have time to get through all of these. There was one question that actually was very similar to one that we had baked in that I want to address. And it is, are interest-bearing or yield-bearing stablecoins now banned in the US? And the answer to that is, well, not quite. There is some nuance here, as Genius draws an important distinction. Permitted issuers cannot pay interest, yield, or staking rewards in connection with the holding or using of a payment stablecoin. If they do, the token risks losing its payment stablecoin status. However, DAF, like exchanges or broker-dealers, are not necessarily prohibited from offering rewards or kind of staking on payment stablecoins. But this can also be subject to other laws including potentially securities and also consumer protection regimes. So it's definitely a more kind of nuanced answer than it might first let on. And we'd be happy to take any questions in the chat and kind of maybe put together a kind of Q&A document and then post it onto the site at a later date. But we are now out of time, and we definitely appreciate everyone being here, and I hope that you learned something new today.